So Caroline Flammer is the A. Barton Hepburn Professor of Economics at Columbia University, with joint appointments at the School of International and Public Affairs and the Climate School, and a secondary appointment at Columbia Business School. Caroline is also a research associate at the National Bureau of Economic Research, a research fellow at the Center for Economic Policy Research. We are in for a treat today with sustainable investing. So Caroline, over to you.
Thanks so much. Let me share my screen. Let's see whether that works. Oops. All right. So let me perhaps start by just stating the obvious here. We are in the midst of multiple crises: biodiversity loss, climate change, social inequality, poverty, etc. The general response by academia, but also by society more generally, is it's the government's role to regulate and to actually address these crises. But if you look outside of the window, unfortunately, governments, let me put it diplomatically, are unable to effectively address these crises. Otherwise, we wouldn't be in the midst of these crises. And so this puts the spotlight on the private sector, both the real economy and the financial sector. And the question is, what can they do and to what extent to help mitigate these grand societal challenges? Now, when you look at the current practices of corporate sustainability, ESG, sustainable finance, whatever term you want to use, our thinking, our frameworks, our models, our practices are really confined to the portfolio level and firm level. Now, what do I mean by that? Well, let me zoom in on the real economy first, on the corporations. The way we currently, for example, assess the environmental footprint of a company tends to be Scope 1. This means the direct emissions of a company. We tend to ignore Scope 2 and Scope 3, meaning the emissions of the energy that the companies consume, as well as the energy of the customers and the suppliers, so that's Scope 3. We also tend to ignore, for example, whether or not companies lobby against climate policies or engage in campaign contributions, etc. Correct? So we only look at a very specific small tranche of the holistic, more holistic approach of companies, what they may or may not do with respect to climate. I could make a similar example with diversity, equity, inclusion. Many companies take actions in this space, but very often we only look at, for example, we only consider a firm level approach, meaning we consider, for example, how many women do we have on the board? Or how many women do we have in top management? But that might actually only look at, lead to a poaching of top talent from one top company to the other. But it doesn't mean that we address the underlying challenge of social inequality. It does not mean that we provide greater accessibility and social mobility, correct? It does not mean that more women move up the ladder within the career. Let me flip over to the financial sector. For example, there is a lot of pressure on investors to divest from fossil fuel industry or other kind of dirty or bad industries, so to speak. But if you think about what really happens when they divest, well, they clean up their portfolio. So this is what I mean by portfolio level view. What I discussed before is kind of this firm level focus. We don't really consider the system, correct? Now, moving over to the financial sector, again, for example, with divestment. If you divest, what happens is you clean up your own portfolio. But does it really change the actions of the underlying portfolio company you just divested from? Probably not. Perhaps even they worsen their environmental performance. So to really trigger a change in the real economy, a potentially more fruitful avenue would be to stay invested, but then to actively engage with the management of the portfolio company to change their business practices and to really clean up their act, if we now talk about climate, for example. Two more examples before I move on. Another example is, if you think about the key theory that we have in finance, the modern portfolio theory, there's one key assumptions that we are making, and that is that exogenous, that systemic risks such as climate change, biodiversity loss, and social inequality, that these are exogenous. So meaning we basically just assume away any interrelationship of our investments on these grand societal challenges, and we assume away that if we don't address these system level challenges, that these challenges, the risks and costs of these challenges worsen over time and negatively impact the financial performance of our portfolio in the long term. So de facto, we essentially ignore this interrelationship here, and we just assume away that systemic risks are endogenous, and we just assume they're exogenous. Okay. Similarly, typically we think about, okay, the government puts in place certain regulations, and what's the ideal action, what's the ideal strategy of a company, or similarly, what's the ideal reaction of an investor. We give very little thought about to what extent can the financial sector and the real economy engage with policy and shape the rules of the game, okay? And basically inform the government, but also to potentially nudge the government to put in place the public policies that we would need in order to really address these system level challenges. Similarly, as I mentioned before, we don't really include this in our assessment of the performance, be it the environmental performance. We don't really consider whether or not, for example, companies engage in lobbying for or against climate policies, okay? So in other words, we really basically need to improve our metrics, the way we assess the environmental, social, and governance performance of companies, and take a more holistic view. We should also move away from just firm level and portfolio level thinking and take a more systems-focused approach. And the last one I'm going to mention is about blended finance. So if you think about how have we financed the mitigation of climate change, biodiversity loss, social inequality, poverty, and similar challenges, it has been traditionally funded through public funding and philanthropic funding. But there's a huge financing gap that we are facing, and the question is, how do we close that financing gap? Especially in today's situation, public funding is decreasing. For example, US aid has been cut. Many public funds in Europe, they are shifting away from SDGs. They are moving towards resilience and defense, basically, of Europe. And so that financing gap worsens, it increases. Now, there's trillions of dollars out there in the private capital market, but private capital doesn't necessarily flow yet towards these innovative solutions, be it in climate tech, renewable energy, nature-based solutions, and social innovation. And so this is where blended financing comes in, where you blend different types of capital, of philanthropic and public funding, to help subsidize and de-risk private capital investments so that these investments become investment opportunities for private investors. And obviously, there's a whole range of different private investors, from family offices to impact investors, all the way to asset managers, pension funds, sovereign wealth funds, etc. And they will have different preferences, etc. So let me conclude with some executive education offerings that we provide, and that really speak to all these points that I just mentioned before. So we have basically 3 programs. One is more on the financing side of things, where participants learn how to engage in system-level investing, which I would consider the new frontier in sustainable investing, where you discuss opportunities and challenges of implementing conventional tools and advanced techniques available to investors to trigger systemic change. So this goes beyond just capital allocation. It includes portfolio engagement, coalition building, policy engagement, and much more. Now, the Sustainable Business Stewardship Academy is the other side of the coin, so to speak, from the corporate perspective. And this is where participants learn how to integrate and align their CSR and policy engagements with their business strategy to sustain their competitiveness and from value. They will also discuss how corporations can act as stewards of the systems and engage with policymakers to really trigger change. And lastly, that's the COE Blended Finance program, where participants will learn how can you actually blend different types of capital, so public, philanthropic, and private capital together in order to subsidize and de-risk private investments into climate tech, nature-based solutions, renewable energy, etc. Well, I must be selfish here and say, check our website, be in touch. So I think I put the email address into the chat and the website. So these are certainly, we try to provide, be a platform for resources for this kind of information. And then there are different networks, correct, from impact investors, system investors, etc. There are obviously different networks that also provide resources. Yeah, but happy to really direct you towards other sources of resources as well. But first and foremost, check our website and check our community of scholars.